Bitcoin just crashed over 50% from its all-time high. Your crypto portfolio might be bleeding right now. MSTR shares, a bellwether for institutional Bitcoin adoption, are down 38% in 1 month. This isn't just another dip. Here's what's wild. Fear has reached a peak. Investors are fleeing Bitcoin ETFs. They're embracing AI stocks instead. Nobody's talking about the real reason behind this brutal sell-off. We'll reveal why this specific crash is fundamentally different. We'll show you exactly. Let me be direct. The crypto market is in turmoil. Bitcoin and XRP have crashed. Fear reigns supreme. MSTR, the giant corporate Bitcoin holder, is at the epicenter. Their shares plunged Wednesday. MSTR stock hit $97.30. This was a 5.5% drop on the day, just 30 minutes after the opening bell. Look, this recent dip is just accelerating a tailspin. MSTR shares are down 20% in the last week. They've fallen over 38% in the past month. That's a brutal hit to your money. Here's the thing. The last time MSTR traded under $100 was March 1st, 2024. Bitcoin was around $61,000 then. Both spiked dramatically. Both have fallen substantially since. MSTR shares peaked above $400 in 2025. That was when Bitcoin was flying high. President Donald Trump's crypto-friendly policies sparked optimism. Bitcoin itself hit a new all-time high. It soared above $126,000 last October. Now, it's trading at $60,935. That's a staggering 50% drop. This is its lowest price in 2 weeks. Now pay attention. Investors are fleeing Bitcoin ETFs. These are exchange-traded funds. They allow you to invest in Bitcoin without owning the underlying asset directly. People are now embracing larger potential gains. They're trading AI stocks. The Federal Reserve also adopted a more hawkish tone. This means they are leaning towards higher interest rates. Higher rates often hurt speculative assets like crypto. Strategy, with its $52 billion Bitcoin treasury, is a key player. They invented the crypto treasury model. This model spread to other coins last year. MSTR's moves boost BTC in bull markets. They also dampen enthusiasm during bearish swings. And get this, Bitcoin struggled to recover after falling below $70,000. That happened around the start of June. Strategy then disclosed its first BTC sale since 2022. This shattered the buy and never sell ethos. Company co-founder Michael Saylor has espoused this for years. This action sent shockwaves. Nobody's talking about this. Forget max pain theory. Bitcoin is well below the $72,000 magnet. A $10 billion options expiry looms. This is happening Friday at 8 o'clock Eastern Time. Max pain theory suggests prices gravitate to a level. This is where options buyers lose the most. Option writers, the sellers, benefit. The current max pain level is $72,000. Spot prices are around $61,700. Bitcoin crashed from $67,000 to under $60,000 Wednesday. This undermines the theory. Recent settlements showed no pinning effect. This is a major liquidity event. It will spur volatility. Billions in contracts will expire, or they will roll into future dates. This history sets the stage. It shows why current market dynamics are so critical for your money. To understand the gravity of today's market, we need to rewind a bit, tracing the path that brought us to this critical juncture. Cast your mind back to 2024. Bitcoin was trading in the $61,000 to $62,000 range, and strategy shares, MSTR, were also hovering below the $100 mark, much like where they sit today. But oh, how different the sentiment was. That was a period of consolidation, a coiled spring preparing for an explosive move. Indeed, that spring unwound spectacularly. By 2025, optimism surged through the crypto world. President Donald Trump's increasingly crypto-friendly policies acted as a powerful tailwind, sparking a wave of enthusiasm among traders. This positive sentiment fueled an incredible rally. Strategy, the pioneer of the crypto treasury model, saw its shares peak above an astounding $400. This wasn't just a win for Strategy. It validated the entire corporate Bitcoin accumulation thesis, drawing in more institutional interest. The momentum carried through, culminating in Bitcoin itself setting a new all-time high above $126,000 last October. The digital asset looked unstoppable, a beacon of financial innovation. Strategy, holding an enormous $52 billion in Bitcoin, seemed to be riding an unstoppable wave, championing the buy and never sell, ethos espoused by its co-founder Michael Saylor. For years, their unwavering commitment to accumulation was a psychological anchor for the market, boosting BTC during bullish times and instilling confidence. But the tide began to turn. Just this past June, Bitcoin struggled to recover after falling below the $70,000 mark. This wasn't just another dip. It coincided with Strategy making a seismic disclosure, its first BTC sale since 2022. That single act shattered the long-held buy and never sell mantra, sending ripples of doubt and uncertainty through the market. If even Strategy, the ultimate hodler, was selling, what did that mean for everyone else? This move arguably dampened enthusiasm, exacerbating the bearish swing we're now witnessing. Investors, spooked by the shift from a corporate titan and a more hawkish tone from the Fed, began to flee Bitcoin ETFs, redirecting their capital towards what they perceived as larger potential gains in AI stocks. And now, here we are, with Bitcoin hammered down to $60,935 and MSTR shares crashing to $97.30, down 38% in the last month. The journey from $126,000 to just above $60,000 has been brutal, driven by a confluence of shattered ethos, macro pressures, and a flight to new narratives. This history sets the stage. It shows why current market dynamics are so critical for your money. Now, seasoned crypto investors might be thinking, haven't we seen this before? Another crash, another dip, another opportunity. And yes, some aspects of this downturn feel familiar. The intense volatility, the widespread fear gripping the market, the urgent flight to perceived safety. These are hallmarks of crypto cycles, echoing the brutal 2022 crypto winter or even the sharper corrections we saw in 2021. Just like then, the macro environment, particularly the Federal Reserve's stance, continues to exert significant pressure, and market sentiment remains fragile, prone to panic selling. But to simply dismiss this as another dip would be a grave mistake. This time, there are genuinely new and powerful forces at play that differentiate it from previous cycles. For one, the much-touted max pain theory, which seemed to guide Bitcoin's price around options expiry in the 2020-2021 bull run, is demonstrably failing. We're seeing prices move away from the theoretical max pain point, not towards it, undermining a long-held belief among options traders. This suggests a more organic, less manipulated market dynamic, or perhaps simply a market overwhelmed by selling pressure. More significantly, the buy and never sell ethos, once a bedrock of institutional confidence, has been shattered by Strategy's recent Bitcoin sale. This isn't just a company adjusting its balance sheet. It's a symbolic shift from the most prominent corporate Bitcoin holder. In past cycles, we saw retail hodlers, but never such a foundational corporate entity, publicly deviate from a strategy it championed. This move creates a new precedent and a new layer of uncertainty that wasn't present in prior downturns. Furthermore, the landscape of capital allocation has fundamentally changed. While Bitcoin ETFs brought unprecedented institutional access, we're now witnessing significant outflows as investors actively flee these vehicles, a dynamic not present in earlier, pre-ETF crashes. This capital isn't just sitting on the sidelines. It's actively being reallocated into competing sectors like AI stocks, creating a powerful narrative pull that didn't exist in previous cycles. The sheer gravitational force of this new competition for investment dollars makes recovery far more challenging. This isn't just a normal crypto correction. It's a recalibration of investment priorities on a scale we haven't witnessed before. We're going to dive into the real numbers behind this capital flight. And okay, let's cut through the noise and look at the cold, hard numbers driving this market panic. First, the most immediate pain point, MSTR shares. They've plummeted by a staggering 5.5% in a single day, dropping to $97.30. This isn't just a bad day. It compounds an already brutal trend. In the last week alone, MSTR is down 20%, and over the past month, the stock has shed a painful 38% of its value. For a company whose strategy is so intrinsically linked to Bitcoin, these numbers reflect a deep-seated concern among investors about their core asset. Now, let's talk about Bitcoin itself. The flagship cryptocurrency has fallen over 50% from its all-time high above $126,000, now trading around $60,935. Think about that. Half of its peak value evaporated. This isn't a minor pullback. It's a full-blown capitulation for many. Strategy, the company we just discussed, holds a massive $52 billion in Bitcoin. This figure is crucial because it highlights the sheer scale of exposure they have, and why their stock acts as such a strong proxy for Bitcoin sentiment. Here is what the data actually shows. MSTR trading under $100 isn't entirely new territory. It last dipped below this mark on March 1, 2024, when Bitcoin was also trading in a similar range, specifically between $61,000 and $62,000. This is significant because it suggests a correlation, but also a potential ceiling or floor that the market keeps revisiting. Most people do not realize that while MSTR shares peaked above $400 in 2025, a time when Bitcoin was soaring post-Trump's crypto-friendly policies, the current price reflects a complete reversal of that optimism. That $400 peak in MSTR now feels like a distant memory, showcasing how quickly market sentiment can shift. Another critical number that has been widely discussed is the $72,000 max pain level for the upcoming $10 billion options expiry. The popular max pain theory suggests that Bitcoin's price should gravitate towards this level as options writers try to maximize their profit. However, here is where we challenge a common assumption. Bitcoin's price has actually fallen from around $67,000 to below $60,000 ahead of this expiry. This is a clear divergence from the expected pinning effect, demonstrating that in this particular cycle, the max pain theory is not playing out as many anticipated. The $10 billion in options expiring on Deribit on Friday at 8 o'clock Eastern Time is undoubtedly a major liquidity event, but its influence on price, at least in the short term, appears to be less about a predictable magnet and more about driving volatility as contracts settle or roll over. The market is not behaving predictably according to old theories, and that's a crucial insight for anyone trying to navigate these choppy waters. The fact that Bitcoin struggled to recover after falling below the $70,000 mark around the start of June, right around the time Strategy disclosed its first BTC sale since 2022, further underscores the fragile nature of current market dynamics. So what's the bull case amidst this fear? For Bitcoin to not only recover but thrive, several factors need to align. First, a significant pivot from the Federal Reserve towards a more dovish monetary policy is essential. If interest rate cuts are back on the table, it would likely reduce the appeal of safer assets and push capital back into riskier, high-growth plays like crypto. We'd also need to see a reversal in the current trend of Bitcoin ETF outflows. For the bulls, the $60,000 level needs to prove a resilient floor, sparking a wave of accumulation from long-term holders who view this as a discount. Renewed institutional interest, perhaps spurred by positive regulatory clarity or a shift in the perceived risk-reward of AI stocks, could also provide the necessary liquidity and buying pressure. Finally, Strategy's own actions will be critical. If they resume their aggressive buy and never sell posture, it could reinstill confidence, signaling that even the largest corporate holder believes in the long-term value at these lower prices. The underlying technology and scarcity remain strong arguments, and if the macro environment improves, a rebound to the $70,000 mark and beyond could be swift. On the flip side, the bear case presents a much grimmer picture. Continued hawkishness from the Fed, potentially driven by persistent inflation, could keep interest rates higher for longer, making speculative assets like Bitcoin less attractive. The current trend of investors fleeing Bitcoin ETFs and reallocating capital into AI stocks could accelerate, creating a sustained drag on demand for crypto. If Bitcoin fails to hold the $60,000 support level, we could see a cascade of liquidations, pushing prices significantly lower, possibly even towards the $50,000 range or below. Further sales from major corporate holders like Strategy, or even the perception that they might liquidate more of their holdings, would shatter market confidence and remove a significant buying force. Regulatory uncertainty, particularly in key jurisdictions, could also stifle innovation and adoption. In the worst-case scenario, a prolonged bear market could see many altcoins disappear, and Bitcoin could enter a multi-year consolidation phase, struggling to regain its previous all-time highs for an extended period. The sheer volume of options expiring far from the max pain level also indicates a market that is not easily manipulated upwards, suggesting that organic demand will be the sole driver, which is currently lacking. So which side is right? That depends on what you do with this next. If you're a long-term investor who bought into Bitcoin above its current $60,935 level, particularly near that $126,000 all-time high, Your portfolio is now facing a significant drawdown of over 50%. A $10,000 investment made at the peak is now worth less than $5,000. For those who diversified into MSTR shares, perhaps buying above $400 in 2025, your investment could be down over 75%, with a $10,000 stake now valued around $2,500. This isn't just a paper loss. It's a profound test of your conviction. Your long-term thesis might still be intact, but this market is proving far more volatile than many anticipated. This isn't necessarily the time for panic selling if your original conviction holds, but it is absolutely the time for a thorough reevaluation of your risk tolerance and initial investment thesis. The emotional toll of watching your capital erode like this is real, and it can lead to irrational decisions if you're not prepared. For you, the short-term trader, this environment presents both heightened opportunity and extreme risk. If you were primarily long Bitcoin, perhaps betting on a bounce from the $70,000 mark, you've likely incurred substantial losses, potentially 10 to 15% of your trading capital if you didn't swiftly manage your stop losses. The rapid drop from $67,000 to below $60,000 in just a few days can decimate weeks of careful gains. While opportunities for short positions have been present, accurately timing bottoms and tops is notoriously difficult. This market demands an ironclad discipline, extremely tight stop losses, and realistic, conservative profit targets. Chasing pumps or attempting to catch a falling knife without a robust strategy could quickly deplete your trading account. A 5% swing against you on leveraged positions can mean a 50% loss of your margin, putting your income at serious risk. And if you've been sitting on the sidelines, perhaps with $5,000 to $10,000 in savings, watching Bitcoin's meteoric rise and subsequent crash, this is a pivotal moment. On one hand, the over 50% drop from the all-time high above $126,000 might make it seem like a discount or an enticing buying opportunity. Your $5,000 could now potentially buy twice as much Bitcoin as it would have at the peak. However, the pervasive fear and deep uncertainty, coupled with the real potential for further declines below $60,000, means that allocating your hard-earned savings into a volatile asset like Bitcoin right now carries substantial risk. Your $5,000 could easily become $4,000 or even less in a short period if the downward trend persists. This isn't about missing out. It's about rigorously protecting your capital and understanding that market bottoms are rarely obvious in real time. So what should you do now? Here is your 90-day now. Let's talk about the key indicators to watch in the next 90 days. First, keep a close eye on Bitcoin's 200-day moving average. This is a critical long-term trend indicator. If Bitcoin decisively breaks and holds below its 200 DMA, currently estimated around $58,000, that is your signal that the bear market could deepen significantly and may be prolonged. Second, monitor MSTR's share price. As a proxy for institutional conviction and a major corporate holder, MSTR's performance is incredibly telling. If MSTR shares drop below $90 and stay there for more than 3 consecutive trading days, that is your signal for increased institutional capitulation and a potential further decline in Bitcoin. Third, watch the Federal Reserve's interest rate decisions. The Fed's continued hawkish tone is impacting all risk assets. Watch for any definitive statements on rate cuts or hikes in their next 2 FOMC meetings over the next 90 days. If the Fed signals continued hawkishness with no rate cuts on the immediate horizon for 2026, that is your signal to remain highly cautious and reduce risk exposure across your entire portfolio, as a tighter monetary environment will continue to pressure growth and speculative assets. The big picture is coming up next. Beyond the immediate price action and the Federal Reserve's pronouncements, we need to zoom out and understand the tectonic plates shifting beneath the surface. What we're witnessing isn't just a typical market correction. It's a profound repricing of risk in an environment where the cost of capital is fundamentally changing after years of ultra-low rates. This isn't merely about battling inflation or fearing a recession. It's about the systemic unwind of over-leveraged growth narratives that thrived on cheap money and the reallocation of capital towards assets with intrinsic value. We are firmly in the pain phase of the market cycle, a period of significant value destruction for speculative assets, but also one that sets the stage for the next wave of genuine innovation and sustainable growth. Most people are fixated on the daily headlines and chasing the next bounce, but what they're missing is the deeper narrative. This isn't just a crypto winter. It's a global liquidity crunch manifesting across all risk assets as capital seeks safety and yield. The market is purging years of excess, and this painful, but necessary, process is recalibrating valuations across the board. This is precisely where the smart money starts to identify generational buying opportunities, not by chasing rallies, but by understanding these underlying economic shifts and the true cost of money. My bold prediction for the remainder of 2026 is this. Despite the Fed's current hawkish rhetoric, they will be forced into an emergency dovish pivot by Q4. The reason? Not because inflation is miraculously tamed, but because the systemic pressure from escalating sovereign debt yields and a deepening global credit crunch will become untenable, forcing their hand to prevent a full-blown financial crisis. This pivot, when it comes, will be swift and dramatic, signaling the true bottom for many of these currently battered assets, but only after a final, excruciating capitulation event that shakes out the last weak hands. So, to recap the 5 biggest takeaways from today's, if you found this breakdown valuable, subscribe. We drop new finance videos every day. And watch our other videos to stay ahead of the market. Follow for more information.